and welcome to this evening's webinar, AAII and Better Investing, Building Wealth with Small Cap Stocks. We'll give everyone a second here. While we're waiting, I want to thank everyone for joining us. We're happy to have you all here. So my name is Susie Artsberger, and I'll be your host tonight. A few things to go over before we begin. I want to remind all our webinar attendees that both AAII and Better Investing are nonprofit educational organizations and are not financial advisors. Therefore, we are not able to provide personal advice. Every investor is different. That's why our goal with each broadcast is to educate you on how to make better financial decisions. So we have two great speakers tonight, Doug Gerlach from Better Investing and John Bajkowski from AAII. I would like to thank both of you for being with us this evening. And in this presentation, Doug and John will share how their organizations approach small cap investing to help individual investors uncover long-term opportunities. Specifically, Doug will introduce the Small Cap Informer, Better Investing's newsletter focused on identifying high potential small cap stocks using its proven quality growth at a reasonable price strategy. John will highlight AAII's model shadow stock portfolio, a value-based strategy focusing on small and micro cap stocks. They'll also show how to identify promising small cap value stocks using AAII screening tools and A through F grades. To you, our attendees, be sure to keep an eye out on the chat throughout the webinar, as we'll be sharing helpful resources, key insights, and other relevant links and resources. During the presentation, if you have any questions for our speakers, please send them using the questions section of our GoToWebinar control panel. Once the presentation concludes, I'll select a few questions for Doug and John to answer. And if the question isn't answered during the broadcast, feel free to email members@aaii.com or service@betterinvesting.org. If you experience any issues with the audio or video of the webinar, please visit the GoToWebinar support at gotowebinar.com for assistance. And just a friendly reminder that this presentation is being recorded. If you have to leave for any reason, you'll be able to replay the whole event. A link to that webinar replay will be sent to all attendees later this week. And the recording will also be accessible at aaii.com/webinars or youtube.com/betterinvesting. So we love that our webinars are interactive. After the presentation, we'll host a live Q&A, including two special promos from AAII and Better Investing. And so please be sure to stay for the entire broadcast. And with that, I'd like to hand the presentation over to Doug to kick us off.
Thank you, Susie, and good evening, everyone. Welcome. Glad you could join us tonight for this educational presentation. I'm going to be kicking off talking about small company investing for long-term investors. As part of Better Investing, our approach to individual stock analysis is based in the benefits of buy and hold for the long term. And we've applied that in our small company stock newsletter, and I'll talk about that approach as we go through. This is our disclaimer. Of course, this is an educational presentation, and we will be discussing particular stocks during the presentation. These are not recommendations. We always recommend that you do your own due diligence and research before making any investing decision. Now, as part of Better Investing, our little subsidiary that I head up publishes 3 investing newsletters. Our flagship is the Investor Advisory Service, a newsletter that was founded way back in 1973. It's been named to the Holbert Investment Newsletter Honor Roll for 15 consecutive years for outperforming the market in both bull and bear market cycles over the long term. In 2013, 2012, we started the Small Cap Informer using our long-term approach to target smaller companies. And in 2023, we founded a dividend newsletter focused on dividend growth and capital return, not necessarily yield. But we're going to be talking about the Small Cap Informer tonight and the things that we've learned in the 12 plus years since we started the newsletter. Now, this is a monthly newsletter for to present small stock ideas for individual investors. We use a disciplined methodology that looks at quality companies, trying to attempt to purchase them at reasonable prices and generate above average total return prospects compared to the broader small cap indexes. We do utilize a long-term buy and hold strategy. That does not mean buy and never sell. It is part of our methodology to monitor the fundamental performance of companies along the way and make sell decisions when necessary. We have outperformed the S&P Small Cap 600 index over the long term since we've started the newsletter, and I'll show you that track record in a moment. Here's some sections of the newsletters. As you can see, this is a traditional print-based newsletter. Most of our subscribers elect to get it electronically, which means they download the issues when they're published and they can print them or read them on their tablet or computer. This is our track record since the newsletter was founded. We've had a great run this year, especially since August, as the small cap markets have kind of turned around and reversed the trend, and we've seen a number of companies performing quite well. But our long-term 3-year and 10-year performance way outweighs the performance of the S&P Small Cap 600 index. Yes, compared to the returns from the Magnificent Seven or any broad market index, the S&P 600 has not been delivering exemplary results, but it's our belief that sector shift will happen at some point and we'll see small caps coming back into dominance. The benefits of small cap stocks from BetterInvesting's perspective are quite good. They suggest that 25% of an individual investor's stock portfolio is devoted to small company stocks. This is because both small and large company stocks tend to perform at different times in the market cycle. And as we all are probably aware, small company stocks have historically bettered the performance of large caps over the long term, recent history notwithstanding. So the methodology that we employ in the small cap informer, first and foremost, we're looking primarily at companies with annual sales between $100 million and $2 billion a year. This is a pretty small segment of the broader market. We do continue coverage as companies perform well and exceed that. So we do have some of our top performing companies have grown beyond that 2 billion mark, and we still carry them in the newsletter. We don't make new recommendations for those companies. And we do also occasionally track companies that have annual sales below $50 million, which is really in the what we consider the micro cap space. You'll see more of those, I expect, when John presents later on about some of the AAII tools. We are open to any sector and industry in our coverage. But in practice, we rarely find utilities and energy companies that fit the model. Companies must be profitable. That is a key criteria. Typically, we like to see at least 3 years of operating history. So there might be a newly public company if we feel like we can purchase it at a reasonable valuation. But otherwise, the companies have to be demonstrating that they're able to generate earnings. And that will be the baseline that we're going to support use to support our future growth projections. Now, our approach we call QGARP, which is based on the growth at a reasonable price methodology that Peter Lynch popularized back in the 1990s. But we really felt like that didn't tell the whole story. We have a focus on quality. And when you're investing in smaller companies, those quality metrics become quite significant. So we appended or prepended the Q to GARP to come up with QGARP. We do use the Better Investing Stock Selection Guide, or SSG, as a starting framework. If you're unfamiliar with that tool, you can look back at the recording of our first webinar that we did with AAII, and we reviewed some of the precepts of that stock selection guide, and there are plenty of other resources. This is an analysis tool that is used to identify growth, quality, and valuation metrics for a company. So we'll start with the QGARP. We'll start with the growth criteria. Of course, we like to see sales growth, and sales growth is required to drive earnings growth. And earnings growth is required to drive long-term capital appreciation, which is to say that if we find companies that consistently increase their earnings per share, that have significant tailwinds in place to drive future performance, then eventually, ultimately, the share price will catch up with that growth. In the short term, of course, anything can happen. In the short term, markets behave irrationally, and that provides an opportunity for us, in many cases, to purchase undervalued or underappreciated securities. But we do require growth. In our framework, however, because of our bias towards reasonable price or reasonable valuations, we're not looking at high-flying growth companies. We skew more towards small cap value. And so our baseline minimum growth estimate for any company has to be around 8% or better. Yes, we love to find fast-growing companies, but often those are way too expensive for our Midwest ethos to absorb. And when you overpay for companies, you increase the risk in your portfolio and the potential that your returns are not going to meet your objectives. The growth trends provide a base of analysis. They are not the be-all, end-all. We're not looking at the past performance to judge future performance by, but we are looking at what are the components of that growth. What has caused this company to grow at this particular rate? What are the tailwinds and headwinds? What are the drivers? What are the obstacles the company is likely to face in the future? And that will allow us to confirm that this is a company worthy of consideration or eliminate it as one that doesn't meet our criteria. This is a good example of a company that has been growing for a decade. It's been growing at a very consistent level. On the top are the revenues or sales. The blue line is the earnings per share, and you can also see the high and low annual prices indicated there. And on the 2025 year, you can see the current price midway between the high and low of the last 52 weeks. This is Addus Home Care. This is an Illinois-based company that provides home health care services. So you can see a little bit of variability in their earnings and certainly in their valuation during different cycles of the economy and what's going on with regulation related to Medicare and Medicaid. But all in all, the company has weathered the storm quite well, and growth is expected to continue. That average growth over the 9-year period is 15.4% for sales and 18.9% for earnings. So this is a little bit of a faster growing company than many that we track. Here's another company that has somewhat less consistent growth, but you can see over the last few years, this company has been growing more consistently, and that's what we like. This is Palomar Holdings. Ticker is PLMR. This is a property and casualty insurance company. However, they focus on some different areas of the market that aren't going to be as impacted by the terrible weather in Texas or Florida, for instance. And that allows them to have a high quality portfolio and are definitely growing the business, as you can see on this graph. And this is a good example of a company where we might look back and say, well, what happened 5 years ago or 8 years ago to this particular company? We see some earnings shortfalls, but the bottom line is that they seem to have ironed out those problems. So we like that. And when you see the price here, the price bars, you can see that in 2023, the price dipped down, even though earnings and revenues were growing. And that became a good opportunity and entry point for us, we felt, in order to benefit from that mismatch of price and fundamentals. Now, I've spoken a lot about the value formula, the reasonable price criteria. It is so important whenever you're investing in individual equities, but especially with small cap stocks, to be rigid and focused and have a good discipline when you're making those buy decisions. We look at the PE ratio and expect it to be reasonable when compared to the history and the future expectations of growth. We do avoid high flyers. So PE is greater than 30 or 35 tend to be set aside, and we will wait for that valuation to fall down a little bit, and then maybe we'll have a better opportunity to purchase. We are often contrarian in that we seek out those mismatches between what the market thinks a company's worth and what our estimate may be. And again, that focus on fundamentals, that focus on the long term, when the rest of the market is worried about what's going to happen next week or next month or next quarter, we're thinking about what's going to happen after the dust settles and the company is into its next growth phase. And that gives us opportunities. We've often found that it is more advantageous in the small cap side to focus on value as opposed to growth. It's relatively easy to find small companies that are growing at 30%, 40%, 60% a year, but there's simply too much risk involved for us to be enticed by those companies. Here's a graph of the 10-year PE ratio history of a company, UFP Technologies, ticker is UFPT. You can see what's interesting is that this is the annual high and annual low PE ratios. So you can see that the stock essentially moves in a band, almost like a price band. And sometimes that PE ratio takes off and sometimes that PE ratio falls. But by and large, that variance between the high and the low is at a particular range. I've marked on the right side the current PE of this particular company. So it is pulled back in price. And again, we see that as an opportunity. The current PE is close to the lowest PE of the last 52 weeks, and it's also of the prior fiscal year, and it's also not too far out of the range of the lowest PE ratios the stock is traded at on an annual basis. So again, a good example of a value formula coming into play. This is a real estate investment trust, so it is a newer public company. So we have data going back to 2019. Valuation very different for REITs than for operating companies in many cases. Here we're seeing the high PE ratio, or actually high price to funds from operations ratio on the high side and the low side. And again, that current PE ratio attractively currently sitting near last year's low PE range. So that gives us plenty of opportunity on the upside. So we like looking for those types of opportunities. And then we come to quality, perhaps the most important and maybe the most distinctive of our approach to small company stock investing. It's our belief that effective management is required to deliver consistent growth. Companies that are growing at a fairly consistent pace year after year after year means that management is paying attention to all of the moving parts that go into running a business. But beyond that, if we find companies that meet our key quality criteria, we see that these companies tend not to be over leveraged. They may carry debt. They may be slightly higher than their own industry group, but their cost of capital is reasonable, for instance, or the trends are good. They're generating free cash. They're paying off that debt. They may be opportunistic with their borrowing to make acquisitions, but diligently pay it down. So debt is not a four-letter word for us. If they're paying dividends, they tend to be well supported by cash and earnings, and cash flow generation is always good. We like to see that. But the real story comes with the pre-tax profit margin analysis. And so we focus on pre-tax profit margin. That takes out the impact of share buybacks, which have become an increasingly common tactic for companies to utilize to boost their earnings by buying back shares instead of paying out dividends. But if we do the pre-tax margin, the pre-tax profit margin analysis, that kind of equalizes the impact of companies that are buying back shares and that are not buying back shares. It also provides a little bit of a baseline to compare ADRs, or foreign domiciled companies, where the tax rate they pay is different than a U.S. tax rate. If we look at the pre-tax profit margin for both of those companies, we take out that tax impact as well. So we see companies that are expanding their margins. That's great. That's very difficult to do with everything that's going on in the economy, with inflation, with tariffs, and the cost of goods, cost of labor, cost of marketing. Companies that are able to increase their margins, management, it must be doing a pretty good job there. So, and then those companies, once we've identified them by the superiority of their margins, as we start looking at the rest of the balance sheet and the income statement, we see that they're just working the business optimally. And so you don't have to spend a lot of time looking at all the other financial ratios. It's really a shortcut. And that's the secret sauce that goes into our approach. Here's a graph of the pre-tax profit margin. So that's the percentage pre-tax profit to sales for semiconductor company Fabrinet, ticker FN. And on this graph, the black line is Fabrinet, and the blue line is the industry average. And you can see Fabrinet's margins just expanding and expanding pretty consistently, while the rest of the industry is trailing behind as they adapt to market conditions and demand. But we like to see that when we see companies that are doing better than the major players in their industry, perhaps, or the average of their industry group and peer group. We find that those are admirable companies that we want to be owners of. Here's another example: Powell Industries, electrical equipment. And again, the black line is their business, their margins. The blue line is industry averages. So you can see, these industrial companies, these electrical equipment makers like Powell, often are seeing their margins kind of drift downwards. The reliance on imported goods and parts makes it difficult when we've got tariffs and costs are going up, but doesn't impact Powell. In fact, they're finding new ways to become profitable. So we like that about this particular business, and this is the kind of trend that we like to see. So our total return objectives, primarily we're looking at capital appreciation as long-term owners of companies. We're looking at earnings growth to drive the share price over time. Many companies pay dividends. We do have some yield payers in our coverage list of about 40 companies, and so that will contribute. And then when we have the opportunity to benefit from PE expansion, that is to say, buy those shares when the PE ratios are low, then that will contribute as well to our total return. And altogether, this is how we hope to exceed the averages for the market. Now, I do want to point out a couple of the kinds of companies that we avoid. If it's an unprofitable business right off the bat, we may put it on the watch list and wait for profitability to arrive, learn about the company, get to know it. But simply because the company has a great story, simply because it has a share of headlines in the media, does not mean that it is a good business that we should consider investing in. We tend to avoid companies that have longer-term downtrends of sales and earnings. If those companies are in our coverage list, we don't let them go for too long before we discontinue them. We avoid turnarounds. We do sometimes embrace fallen angels, but those can be very difficult. Wall Street tends to remember much longer the failures of companies rather than the successes. And so even once the company turns around their fundamentals, we tend to see the market stay away from those companies. We tend to avoid hypervalued stocks. These are stocks at the excess ranges of the overvaluation, where mania and the fear of missing out and other trends are driving the share price. It's not just driven by fundamentals. And again, we find those problematic for the risk that they embody in a portfolio. And penny stocks, and for the most part, micro caps, we avoid as well. We have, in each issue, we focus in depth on one company. That's our buy recommendation. Other than that, we do not automatically recommend any stocks as buys. We function as a research service. We don't have a model portfolio. The objective is, here is a stock you might be interested in. Here's the case for why you should consider it. If it meets your portfolio objectives for diversification and growth, capital appreciation, total return, dividends, etc., then you might put it on your watch list or pick up a few shares the next time you're looking at your brokerage account. We do have in each issue a best for new money category where we pull out those stocks that may have seen their price trip up a little bit, and we see them as good long-term buys at that reduced valuation. So that is the first place that subscribers go if they've got cash that they want to deploy. That's the resource they can look at from there. We aim to hold stocks for 4 or 5 years and through market cycles. That is our strategy. We don't time the market. We don't sell when we expect the market may decline. I don't know how people figure out that the market is going to decline. Nobody seems to have been able to do it successfully. So we're going to hold through and ride the market cycles up and down. Laggards are pruned. That means companies that are not performing fundamentally, and we do strive to get in sooner rather than later. Often we're susceptible to the same cognitive biases that affect all investors, where you say, well, let's just give it another quarter and see what happens. But we do discontinue companies on a regular basis. The oldest stock that we have under coverage right now is 2014. We did cover Air Lease starting in 2013. They just announced that they were being acquired, so we discontinued coverage. We had, I think, the initial recommendation and 3 follow-on recommendations over the course of a dozen years, and we're able to successfully exit that position. We have 73 open positions of 40 stocks. And that is to say that after a year, we may revisit a stock and say, yes, this stock is now in the buy zone once again, or it's still in the buy zone. And so we will recover it from that perspective. Otherwise, we're covering quarterly earnings of every company under coverage, as well as other major news. And when it's warranted, we're going to recommend sells. We've got an on probation list as well. That's our strategy for companies that are fundamentally seem to have some potential problems, but we don't want to jump too quickly if a company's got a temporary problem. So it's a fine balance between identifying what's a temporary problem and what's a fundamental shift in a company's business. So we have an on probation list where we'll move stocks over and say we wouldn't recommend buying unless you're exceptionally risk adverse, unless you've got capital that you really are willing to take a chance on these companies. They could turn out to be duds. Maybe they will recover and they will have some major returns. One of the companies that was on our on probation list until recently for several quarters was the discount retailer Five Below. But the last couple of quarters have been very strong as they've revamped their management team, and that company moved off of our on probation list and back into regular coverage. We also have a valuation watch, which is to say these are companies that we perceive to be hypervalued. If you are worried about the downside, you might consider using trailing stop loss orders to catch them if they do go into a sudden reversal. If you are interested, if this sounds interesting to you, you can get a free taste of the newsletter with our small cap reflections email that comes out about once a month. Provides some commentary, some outlook on the small cap markets, occasionally talks about companies that we cover or have covered, educational and focused primarily, but it's a good way to keep up to date with the performance of the full newsletter. And so you're invited to do that. You can find it on the smallcapinformer.com website. And if you are interested in a full subscription, the promo code AAII or the promo code BETTER will deliver maximum savings. And special offer for the next month, so until October 21st, there's an additional discount on the AAII price. It's usually the newsletter is $249 a year. The AAII discount is $145 a year through October 21st. So if you jump on it this week, it's $95 for that year. So that is a bargain for the performance that you're getting and the insights that we hope to deliver in that small cap product. So with that, I hope that you've gained a better sense of perhaps how small caps can be deployed in your own portfolio. So I'm happy to turn it back over to Susie and to John to tell you more about using small caps to invest as individual investors.
Thank you very much, Doug. Very interesting presentation.
Yeah, thank you, Doug. I'm going to switch it over to John. John Bajkowski is the president of the American Association of Individual Investors, or AAII, and he'll give us the his take on AAII's small cap stock
Thank you so much.
strategies.
And hopefully you can see my primary objective screen.
Yes,
If
we
not,
can.
let me know. Thank you so much.
Thank you.
Yeah, thanks. My goal tonight, I guess, is probably threefold. Is one, to build upon what Doug has talked about as far as small caps, what to expect as far as rates of return, the kind of patterns one individual tends to see with small caps, but then take a look at some of the tools that you as an investor have access to if you want to get those kinds of investments kind of products, be they ETFs, mutual funds, or even direct investing as far as stocks are concerned. The main point, I think, whenever you want to get involved with small caps is you want to really first take a step back and take a look at your asset allocation and make sure that you're cognizant of the risk in your overall portfolio, see what part of your portfolio you want to commit to small caps. They tend to be more volatile than large caps, but they offer longer rates of return. But you have a longer term horizon to do that. And for our members, we have a resource, and anybody who wants to come to our website, we have 3 different allocation models. One for the aggressive investor. In that context, we typically have about 20% of the stock portion devoted towards small caps. We have a moderate investor as well as conservative investors. So with the conservative investor, you may or may not want to have small caps in there. But again, we have tools to take a look at your risk profile, some suggestions as far as what kind of allocations make sense, if depending on your state of growth versus perhaps living off your capital, and also give a sense for how much you could expect the markets to go up or down given that kind of an environment. One other thing I think that often kind of gets confused is, people throw these terms around, small cap, large cap. When it comes to measuring company size, one could look at revenues, one could look at total assets, but for the most part, academics have settled on a market capitalization, which is simply the number of shares outstanding times the current share price. That kind of a public consensus of what a company is worth. You take Apple, for example, they've got 14.9 billion shares outstanding with a share price of 256. They've got a 3.8 trillion market cap, one of the larger companies out there. So it's simply a function of taking the number of shares outstanding times the share price. And in that context, how much is that company's overall worth in the marketplace? Looking at returns of what you can expect to have seen in small caps over the long term versus large caps versus bonds or even cash or inflation. And most studies, cite the Ibbotson information that goes back to the mid-1920s. And we've seen over that time frame for the long term, small caps have returned a higher rate of return than large caps. And in fact, equities in general, if you want to build your wealth long term, you can see why you want to be invested in stocks, you want to reinvest those dividends. If you want to, exceed the rate of inflation, you have to go past Treasury bills. So bonds offer some of that, but not the level of the growth that you can get out of equities. But what exactly is small cap, and what kind of situations occur? And Doug even talked about the notion that small caps don't always necessarily outperform large caps at any point in time. In fact, over the last 20 years, S&P 500 has outperformed what are termed small caps, 10.4% annual rate of return. This is an 8.3% rate of return for small caps that we've witnessed over the last 20 years. Last 10 years, same thing. You have to almost go back 30 years from our end of last year to really have a situation where small caps have outperformed. So the long-term perspective is that small caps have outperformed large caps, but on any given point in time, they may not be. And what exactly is small cap? And when we talk about the academic performance, we just saw that chart that showed the rate of performance of small caps versus large caps. And what is an academic definition of small caps? What is a market participant? What's a mutual fund? When we talk about large caps, we're typically talking about the S&P 500. And most academics break down the capitalization of companies by taking a look at all the stocks on the New York Stock Exchange. They rank them from biggest to smallest and break them down into like 10% decile chunks. They then take those breakpoints that exist and apply them to all stocks, no matter what exchange they exist on. So in this context, looking at the end of a couple of years ago, we see that, and actually the largest stocks here represent information in the last month, but we see that really when we're talking about the S&P 500 and the large cap, really also mega cap stocks, really, we're talking about a small number of companies, 500 companies, but they represent, 85, 90% of the overall market capitalization of all firms. When you see studies pointing to small caps, really talking about micro caps, companies that are the lowest 20 percentile of all companies. The majority of domestic companies trade in that universe, but they overall make up a very small percentage of total market capitalization. So most studies, when they are quoting small cap performance, talking about the lowest 20 percentile of all stocks that have, at this point in time, a market cap of below 800, 900 million. When it comes to mutual funds, however, and you talk about mutual funds that are perhaps labeled as small caps, they're having a market cap of perhaps a billion to 500 billion in size, and that's typically larger than your classic academic definition of what a small cap would be. So just to get a sense that mid caps, anywhere from 6 billion to 23 billion at this point in time in the marketplace. So just to understand is that you as an individual investor have the opportunity to invest in that smallest band of stocks that most public funds cannot touch, because you have the ability to take in positions that won't distort the marketplace. Also, you have the ability to hold on to them over periods of time. So it's important to understand when you hear these terms tossed around. For the most part, most academic studies of small cap are truly micro cap in nature, and most mutual funds that you see on the marketplace are really, in this context, a little bit bigger than what most academics would define as small caps in that context. Another thing to consider and be noting about when it comes to small caps, and in this case, really micro caps, is that they're the one group of the marketplace that tends to have what they call serial correlation, where they run in streaks. They have hot streaks and cold streaks. Over the last since 1933, for the most part, the streaks have lasted about 11 years or so. Where in that context, they have a outperformance of 11 or so years. They then underperform for the same period of duration. Right now, we're undergoing almost a 14.5-year period in which large caps have dominated over small caps. And what typically causes that to reverse is perhaps some level of valuation excess that occurs. I mean, last time really small caps shined was back in 2000, after that whole dot-com bubble, after that great decade of growth of large cap stocks. So again, we're kind of getting to that point now where really small caps as a whole are much cheaper than large caps. But then what kind of catalyst might cause that to change? Well, last year, DataTrek did an interesting study of just the performance of last year, 2024, and they found the environment that small caps did best versus large caps is when interest rates were falling. And again, we're kind of entering that period now. And part of the reason is that most smaller cap companies are more leveraged and are more dependent upon use of debt for financing. And in an environment where all of a sudden rates start to come down, they're able to be a little bit more profitable in that context. So that is perhaps one catalyst that will help small caps bounce back. So now you as an investor, what are your options as far as getting exposure? Obviously, you have to decide how do you want to invest? Do you want to own stocks directly? Do you want to perhaps do it through mutual funds? One good resource that we have on our website, and is an article that Cynthia did for us back last in 2024, is kind of a rundown on how you can gain exposure to the small cap marketplace via mutual funds. And what we're going to do, obviously, anytime we do these kind of webinars here, you'll be getting an email that lists all the resources that Doug has talked about, that I have talked about. So we'll get a link to all these articles and the ability to download them. This is a good article that gives you a good understanding of what the small cap universe looks like, when active versus passive mutual funds might make sense for you, how to analyze mutual funds. And really, it's very important when it comes to that context is how does one compare a mutual fund? And this article will give you that information, give you a list of all caps, different kinds of funds that exist, ETFs that exist, and options you might have in that context. The other thing that you can do as a member, and especially an A+ subscriber, is you can use screens. And we have a number of predefined screens that provide lists of ETFs you can invest in, or funds you can invest in. This happens to be a list of First Cut. It's a First Cut ETF screen that looks for small cap ETFs. And when it comes to screening for performance on funds, it's very important that you compare performance within a category. You want to compare because we've seen that a particular style of fund may be in and out of style. You want to compare small cap growth funds against other small cap growth funds. We want to find those funds that are more attractive against their peers. That's how our grades work when it comes to funds, and that's how your screens should be constructed. Anytime you look at funds, ETFs, you want to compare the expense ratios against funds in the same category. You want to compare performance against funds in the same category. You want to look at what the turnover is, what the expense ratios are, how long the manager's been around, if they're actively or passively managed. But in this context, we have really look like 27 ETFs that kind of meet the quality of being better performance than their peers, a little bit lower risk than their peers, a little lower expenses than their peers as a whole. And you can go ahead and look online and get information on these funds. Whenever you research a fund or ETF on our website, we have access to a full rundown of performance going back 10 years, performance against peers, performance against benchmarks, risk information and whatnot. And this is all available to you as a member of the association. And again, we have special offers on how to get access to that if you're a BetterInvesting subscriber. The other element, of course, when it comes, if you want to prefer to invest in traditional mutual funds, again, there's a lot more options when it comes to that, especially a lot more active investing, active managed funds. But again, we have screens available. We have a top fund screen. It looks, again, similar kinds of criteria to the ETF screen. But in this context, we have, I think, 101 companies or funds that happen to pass this particular criteria. Here I have in the breakdown based on their most recent performance, 1 month, 3 month, whatnot. And the grades here, anytime you see a grade, the grades are comparing a fund against the funds in the same category. So you have apples to apples comparisons. Only way you really could do that with mutual funds and ETFs and have any kind of meaningful work. And then also one of the tools you may find of interest on our website is under funds or ETFs, there's a compare tool. So if you're down to picking between 2 or 3 funds, let's see how they rank based upon performance, based upon risk, based upon expense ratios, one family, what fund family they're in, or even whatever information might be of note to you. Go ahead and just, you can go ahead and choose a compare funds or compare ETF tool, pop in the ticker symbols and get a quick comparison to see how they happen to be available for you. So again, if you don't want to take the time and effort to invest in individual stocks, funds offer a great way to get involved in that ETF small cap universe. And again, be cognizant because look at the fund names. Some funds are small cap, some are micro cap, some will have a bias towards growth, some will have a bias towards value. So whatever sings to you, whatever you believe in, if you're a bargain investor, if you're a growth focused investor, find the fund that you want to stick with over time because you have to live with it for a while. Make sure that you can actually benefit from the kind of exposure that particular fund will offer for you. When it comes to stock resources, we've been doing a lot of information on stocks over the years. In fact, one of the things we've always really focused in on is our small cap stocks. And one of the reasons we felt was that as an individual investor, we have the ability to look at analyze companies that are in the shadows of Wall Street. We have the ability to hold stocks through thick and thin. We have the ability to not have to be worried about moving the market, distorting the market. A large fund cannot take a position in a lot of these microcap stocks. They simply cannot own enough of them to make a difference to their portfolio performance. So that gives you an opportunity to actually invest in these companies before they become the big Wall Street darlings. So back in 1993, founder James Coonan developed the shadow stock portfolio. He had read about some interesting studies and that had pointed out that really when it comes to performance, typically the smaller the company, long term, the greater its rate of return. But also independent of that, typically speaking, the better the value, in this case specifically looking at price to book, typically the better the rate of return as well. And those two factors kind of worked independently. So if you look at the intersection of both the companies that were smallest and the companies that were cheapest, that offered the best opportunity for outperforming the market long term. Now again, it's long term. You have to be willing to hold through to some potential periods of underperformance. But that was sort of the genesis and the rules behind creating this model shadow stock portfolio. So we're talking about, in this case, the smallest decile of companies. We're much smaller than a typical small cap fund. And currently our cutoff is about 400 million. We're looking at funds that are smaller than 400 million. So when it comes to the investable universe with the model shadow stock portfolio, looking at the smallest 10% as far as market cap, looking at the smallest 10% as far as price to book. But really with small cap stocks, as Doug noted, quality is key. You cannot just simply, you benefit a lot from your rate of return if you're able to actually exclude the really poor quality stocks. A lot of small cap stocks are there because they deserve to be there. They're in trouble financially. There's no growth to them. So really, you want to be able to filter out stocks that are poor performers, unprofitable, and whatnot. As very minor initial screens we use for quality, we simply look for positive earnings. In this case, positive earnings historically, positive expected earnings if they happen to have analysts looking at them. We want to make sure stocks are listed on the exchange. I mean, we don't want to deal with pink sheet stocks, penny stocks, at least a share price of $4. And because we're dealing with the price to book ratio, you have to understand what the constraints are of whatever model metric you're using. The price to book ratio doesn't work well with financials. Their financial statements are not comparable to other kinds of stocks. So we happen typically to exclude financial stocks, banks, leasing companies, rental companies, REITs, and partnerships. So it's just because they don't really compare. You can't use the price to book. If we use different metrics, then you could actually use those stocks and conclude them. But we do not use that metric. We use price to book as that basic fundamental element of the shadow stock portfolio. So that's why we have to exclude those particular stocks from our portfolio. And again, this is one of the pivotal articles when it comes to understanding the importance of small cap and understanding the importance of quality of small caps. And it's really size doesn't matter if you control your junk. And if you want to read more about this, it's a great article that discusses that notion. And again, it points to the strength of the strategy of being small cap. It seems to be really a powerful technique that works across different countries, works across many industries. But again, you benefit by controlling quality and making sure you have high quality stocks that are available for you. The other thing I think that in terms of resources for the shadow stock portfolio is if you simply go to our webpage, and this is available to all members, the homepage on our shadow stock area, log in there, any kind of latest transactions that are made. We typically review the portfolio quarterly. What we found is that when you're talking about microcap stocks, frequent turnover is very costly. And it's not the commission cost, it's the bid-ask spread. It's being able to, if you buy a small cap stock one day, you want to sell it the next day, you very well could be giving up 1% or 2% of your value just because the difference between the bid and the ask can be great. So we found it's really costly to be transactional heavy when it comes to microcap stocks. So we found it's best to simply, in the case of the model shadow stock portfolio, review it quarterly. But it's important anytime you have a stock strategy that you go in there with having some ideas of what's going to make you sell that stock when you buy it. And if you go to our website, you go ahead and take a look at the current portfolio. We'll note if there's any kind of warning notes about a given stock, perhaps the price to book is getting too expensive, or if they're in earnings probation. So any kind of notes regarding the actual portfolio will be listed there. If you're looking for fresh ideas, if you just simply want to get some ideas of some small cap holdings that meet the basic qualities of being a shadow stock, we also have this ideas list, and it's updated daily. If a stock happens to be in the model portfolio as well, we'll note it. But it's a chance for you to get some ideas, some fresh ideas, some further research on them if you want to go ahead and analyze them on your own. But when it comes to really, selling, it's important to have those sell decisions figured out in advance. Too often, I suffer from this. I'm sure you guys do as well. You make a buy decision and you wait really to get out an even to prove you didn't make a mistake on the buy side. It's most important to have a very disciplined process in place. When you buy a stock, know what's going to make you sell it on the positive side, on the negative side as well. When it comes to the shadow stock portfolio, notion is we buy them when they're super cheap or super small. We let them grow to be larger, 3 times the maximum initial size when it comes to size or value. We want them to be, move up that value chain or move up that size chain when it comes to stocks. We also sell them when they turn negative. When the earnings all of a sudden become negative on a prolonged basis, again, it's best to let them go. And if a shadow stock's been held for 4 years, it no longer passes, it's underperforming. If it's underperforming the market, we let it go as well and look for new candidates to follow that. Now, the shadow stock portfolio typically holds about 30 stocks. So the notion here is the closer you look at your holdings, the fewer you could hold. If you wanted to simply capture an element, a style of investing, and don't want to do a lot of research on those individual holdings, then you're better off holding a larger group of stocks going to capture that effect. and that's one of the reasons we do hold all 30 stocks with a shadow stock portfolio. Another resource for those who want to basically do their own research and find ideas is our stock screens. We've got 55 different screens, and the best way to get a sense for which screens would be small cap in focus and might have other qualities of interest to you is to go to the AAII stock screens area. What you'll get is a table that lists the performance of all the screens, but under the characteristics tab, you basically have the ability to go ahead and sort the companies that are the average characteristics of all the stock screens we have. They typically have a low PE, a high PE, high growth, high momentum. In this case, I sorted this table by price, by market cap. And I simply look for those on average, which screens currently are having types of stocks that are passing it that are very small in nature. And what I did then is I actually downloaded that spreadsheet. It's available to download. I then went ahead and processed and provided some additional information for anybody's here on our website, our webcast today. And this is, next two slides show all of our stock screens that we have available that we track online. They're sorted by market cap from smallest to largest. And you can see, we talk about Peter Lynch. I think I remember being part of the growth GARP approach to investing. Well, right now, our Peter Lynch screen has an average market cap of 24 million in size. Very small companies. They typically have a B value grade. Growth grade is D, so a little bit on the consistency of growth is kind of why, but the quality is very high. There's no earnings estimate. Not surprising they don't have earnings estimates for something that small. The return from inception is 8.3. It's okay, not the best rate of return as far as our screening strategies are concerned. It does tend to be positive 75% of the years, tracking these since '98, and it's outperformed the S&P only 46% of those years. So it gives you a sense for how consistently have these strategies outperformed. When it comes to our members, I know a lot of them like this O'Shaughnessy Tiny Titan screen, one of the more popular screens that our members follow in the microcap area. The stocks that currently pass it, there's 25. They have an average market cap of 87 million. They tend to be value focused. Growth score, consistency is a D. High momentum, because actually this screen specifically looks for small cap stocks that are attractively valued based upon price to sales, yet are showing strong price momentum. And this other area I want to kind of highlight here for this table you might find of interest are these R squareds. These columns indicate how much of the long-term performance of a given strategy is attributed to the S&P 500, the S&P mid cap, or the S&P small cap. So in this context, the O'Shaughnessy's Tiny Titans, 39% of the performance kind of is attributed to the performance of the S&P 500. About 54% of it is attributed to the S&P small cap. So the smaller this number, the more the screen tends to be independently moving of the market as a whole. In this case, like we see the stock market winner screen, which right now only has one stock passing, so not very diversified there. It's historically had a small number of companies passing, I guess just one, I'm sorry, tends to move nothing at all like any of the market indices. It tends to be moved very independently of those. So if you're looking for diversifying your portfolio, looking for something different, this chart may help highlight, which screens of ours are currently passing stocks that are smaller in nature. Are they value focused or growth focused or momentum focused? What has the performance been over time? How risky are they? Have the return been better than risk-adjusted return better than the market as a whole? So it gives you a sense for how these strategies are out there, which ones are of interest to you, and you can go ahead and look at any of these screens online. Any given day, we'll give you a list of all companies that pass. You could research them further, get a sense for what the criteria that make up that particular strategy are. So it gives you a sense for how to do your homework. So again, you could go ahead and pick mutual funds that match your style for when it comes to small caps. You could look at the model shadow stock portfolio, or you could go ahead and build your own portfolio using the various stock screens that we have available on our website. When it comes to really small caps in general, keep in mind small caps tend to run in streaks, and these streaks last several years to the upside and downside. Small caps tend to be more volatile than large caps, so it's important to have a diversified portfolio in place. take a look at your overall portfolio, not just necessarily one part. You want to have a long-term perspective. You want to make sure you don't need this money over the next year or two. It could take, really 5, 7, even 10 years for you to actually realize the true potential of these particular securities as far as that's concerned. Maintain reasonable expectations. We've talked about having the ability to return a better long-term rate of return from small caps versus large caps, but be reasonable in that. And again, understand that the markets are reasonably efficient, but not perfectly efficient. There are opportunities to find many hidden gems in the small cap arena. Doug's highlighted one great way to find those with the Small Cap Informer. I've given you a couple ideas as well how to do that. So again, it's a great opportunity for us as an individual investor to look at and roll up the sleeves a little bit, get your hands dirty, and find some interesting stocks that are very rewarding in that context. That's all I have. I know that we wanted to make sure we have time for questions. So if Doug wants to come back in, and Susie, if you want to if any questions have come up for us, we'll do our best to try not to get stumped by this.
Okay, great. Thank you, John, and thank you, Doug. Let me share my webcam with the rest of the crew so I can feel like one of the cool kids. And so we did have a number of good questions. I'm going to ask Doug and John a question that came in. Can you comment on the continued reduction of stock available for investment? Have you seen less stocks showing up in screens or harder decisions being made for the Small Cap Informer? So, Doug, I'll start with you.
There is an academic study that has made the rounds this year. It's been done in the past and it's been updated recently. That indicates perhaps that the preponderance of indexing is pulling stocks out of the market, putting them to ETFs and index funds, and that is reducing available shares. But because these ETFs are buying all of these, because the indexes are market cap weighted, these when the ETFs and mutual funds, index funds are buying these mega cap stocks, they're pushing the price up, and the more they push the price up, the more that investors, the more that they have to buy to keep the market cap weighting in their ETFs and index funds in line with their parameters, and so the hypothesis is that in the small company space, the small cap space, there's a lot of neglect. There's a lot of companies that are being ignored because of all these resources that are being deployed in this virtuous cycle of mega cap and large cap investing. So 10 years ago, I put forth a hypothesis that said, I could foresee if these trends continue, that there will be no point in being an individual stock investor, perhaps. It's all going to be productized in ETFs and other funds, and that will be the measure of success, is when when those tiny companies finally get adopted into an index that delivers the returns that are then going to float as the company continues to grow inside that index. So having said that, I don't see in the 13 years that we've been doing the Small Cap Informer, it's been, what a terrible time to start a newsletter in 2012 and go through, we were coming out of a bear market, and the market had recovered from the 2008, 2009. So it was picking up some steam, and then, we had the pandemic, and we had, so we've been kind of whipsawing a little bit. And it's not I would not say that at any time, we are severely impaired at not being able to find companies that fit our model. Yes, there are plenty of times where I say there are so few companies that fit our model, but that's to be expected in the throes of a heady bull market as we are in this, kind of secular bull market that's many years in the making, and all the, in the 21st century, bull markets are longer than they ever were. They just go on and on and on and on, and again feed themselves. So I don't think that I would necessarily agree, but I would love to hear what John has to say.
Yeah, I mean, I guess because perhaps we deal a lot more with the microcap universe, I know we have seen a decrease in the number of publicly traded companies on the smaller cap range. And I probably would, beyond the indexing issue that you raised, I think really when it comes to, I think private equity has played a bit of a role in that. And it's played a role in two ways. You've got the private equity emerging market funds in which the private equity is holding on to these companies for a longer period of time because the founders are able to gain money for their effort through private equity without having to go public initially to get that payback when it comes to actually becoming a publicly traded stock. So we're seeing companies go waiting longer to go public. And then also there's a tremendous, when interest rates were so low, there was a big growth in buyout private equity funds as well, where these companies were going out and acquiring publicly traded companies. They thought that they were being discounted and taking them off the public markets. And again, in this case, the owners love not having to deal with all the expenses and efforts of trying to be a publicly traded company. So yeah, I mean, if you do look, I know we've seen, where we used to see 7,000 publicly traded exchange listed stocks. We're seeing now more in the 4,000 or 5,000 range. So definitely on the small cap side, we have seen a smaller number of companies available for individuals to invest in. But we're still able to find interesting companies to invest in, but it's perhaps not as robust as it used to be.
Sure. Okay, thank you. Great answers. Okay, so second question is, if small caps flourish when interest rate drops, does this imply an increase in debt that they may take on? And the second related question is, what criteria do you use to determine if a company is over-leveraged compared to its peers? So John, do you have a comment on that and how the shadow stock portfolio handles debt?
Yeah, I mean, explicitly, the shadow stock portfolio doesn't look for debt in that context. Typically, when it comes to any kind of screens that we develop, quality is an important element. And I think it's always important to look at the level of leverage that a company has against its peer group. And the other thing to consider when it comes to small cap stocks versus large cap stocks is most small cap stocks don't actually raise traditional long-term debt. A lot of them rely really on bank financing. So we found the best metric to look at the leverage of a smaller company is simply look at the ratio of total liabilities to total assets. And that captures the level of bank debt they might have or revolving credit loans they might have. And again, you want to compare a company against the industry, and you want to look for profitability and rising profitability. So that's my go-to filter for looking at financial leverage, and that is sort of captured in our we have a quality grade that it kind of captures those things. And I know Doug, you probably have some additional metrics you want to talk about.
Yeah, as I pointed out, because of our focus, our quality focus, we find that the companies that at the end of the day that fall through the rest of our filters tend to not have a lot of debt at all, and if they have debt, it's opportunistic. They're growing by acquisition, so they're borrowing money but paying it down very quickly. We like to compare the debt load, debt to capital, debt to equity to the peers and competitors in that small cap space. So the companies that we cover, I have very little concern about debt, and primarily when interest rates come down, it's not because the individuals, every small company is going to benefit from that directly and immediately, but it's because of a perception that it will be easier for them, that if they do have borrowing costs, those will decline. And so, all small caps, good and bad, get lumped together when the market decides, yes, small caps are going to benefit. And so they do. Unfortunately, it's not often enough for my preferences.
All right. And with that, we're going to start wrapping things up. Any closing thoughts, Doug?
It's been a tough number of years to be a small company stock investor, but there's nothing that has thwarted my interest or belief that small company stocks are good to be included in just about every individual investor's portfolio, and it's certainly a lot more interesting, right? And you can own the mega cap basket and have a boring portfolio that has a lot of volatility, or you can do the deep dive and try to uncover the next big winners, and that's always very satisfying as an individual stock picker.
I agree. Definitely, it's like I think we as individual investors have the opportunity to find those hidden gems, to invest in companies that the large companies, just large investment banks, cannot just simply take a position in, because it just simply would be meaningful, would be a rounding error at best. And so, yeah, I mean, I think the important part is we could do your homework. And nowadays, the tools that one can get either through the AAII or BetterInvesting, I mean, the ability to do a deep dive on a company, the ability to do searches on it and get a sense for how they compare against their peers is just tremendous. I mean, it's most people are, I'm guessing, are attending this webinar. A, they want to get educated. B, for them, probably investing is a bit of a hobby as well. And I think, to the extent you're going to have any kind of impact, you probably could have a lot more impact in the small cap arena.
Yeah. Great. Thank you. And thank you so much to both of you for your time and fantastic presentations.
Well, I
want to reiterate that if you have questions for Better Investing, please deliver your questions to service@betterinvesting.org or call us at 877-275-6242 or email Doug directly at gerlach@iclub.com. So, Doug, those emails are going to be flowing in. And similarly, if you have questions about AAII membership tools or services, please feel free to email them at members@AAII.com or give them a call at 312-676-4307. If you have specific questions about the AAII screens or the model shadow stock portfolio, you can email John directly at johnb@AAII.com. And I do appreciate everyone for sticking with us, and I want to reiterate our 2 exclusive attendee offers. I have sent them through in the chat, but let me talk to you about them as well. For AAII new subscribers, there is an offer that is $2 for the first 30 days, and you can find that offer on the website, AAII website at AAII.com/betterinvesting. There are also offers there for AAII Plus and AAII Platinum. For the Better Investing promotion for AAII members is found at betterinvesting.org/AAII, which includes a discounted first year of membership for just $99, and 3 newsletters also offer discounts: Small Cap Informer, Dividend Informer, and Investor Advisory Service. So we hope to see everyone back at the next webinar. It's the 4th Tuesday of every month except December. The next one will be held on October 28th on the topic of ETFs. If you've already signed up for the webinars, you're signed up for all of them, and you'll get a webinar reminder in advance. Recordings of this webinar will be available later this week at AAII.com/webinars or Better Investing's YouTube channel. An email with that link and the presentation slides and additional resources will go out all to all who attended, and that'll go out later this week. So with that, we'll say good night, good health, and successful investing to all of you. So take care, everyone.
Thank you. Good night.
Good night.